Okay.
Okay. Hi, folks. Is there anyone here? If you want to present a deal, we'll put a couple minutes here for deal presentations, if that's okay. Then we're going to do a quick introduction, and then we'll bring on our keynote speaker, Sean McKay from American IRA. Does anyone have any deals they'd like to present for sale, or maybe tell us a deal, what you're looking for, maybe, or a deal that you recently did you'd like to proudly brag about? And there's nothing wrong with bragging. It seems to bring you more deals. If you could, put in the chat box or unmute yourself and give a shout out to your deal. Hello? Well, unless people are having a hard time figuring out the chat or the unmute, I'm going to assume there are no deals. Is that safe to say? Okay. Carlisle says no deal at the moment. Is anyone still buying? I would think so, yeah. I think actually if you're a buyer, I think now would be a great time to buy. I know there's a couple people still buying out there. Carlisle, I hope you get some deals going soon. So, okay, is there anyone at all who'd like to present a deal tonight? Okay, if not, let me make sure our speaker is on. Sean, are you on?
Hey, Bob. Yeah, can you hear me?
Yeah, okay. Sean, let me do this, okay? What I'm going to do is I'm going to go through the presentation. Looks like no one has any deals. This is kind of an awkward way to present them anyway. I hope this lockdown ends soon. But anyway, let me go through the presentation real quick, and I'll hand the reins over to you, okay?
Great.
And by the way, this webinar is being recorded. So the last several meetings I still have to put up in the members area. Actually, just the open web page, okay? But I hope nobody minds. Let me close this chat box. Actually, I'll minimize it. Okay, this is our monthly meeting for the Midlands Real Estate Investors Association. It says 6:30. I said 7 because, you know, this is kind of a truncated meeting because of this being an online meeting. But anyway, now our liability disclosure is that technically speaking, unless one of our regular members, Rich Bolin, is on, or in the case of Sean, he is qualified to tell us about the retirement aspects, the retirement funds aspect. But realistically, no one in our group, including me, is technically licensed to give legal or financial advice officially anyway. We can tell you what we've done, what's worked for us, our experiences. That's about it. Okay, if you question the legal or financial wisdom of anything that you hear, then by all means seek qualified help, okay? Now, some of the goals for 2020 were suggested at a Christmas party last December. And we're going to cover a little bit on owner financing later in the year. Syndication is basically legally pulling money from other investors to buy, especially the larger deals. And what you're going to learn tonight is ideal for syndication, okay? Because there's a lot of people with money in their retirement funds they're not technically allowed to touch yet, but they can invest it in your deals by way of syndication. I'm going to try to get a syndication expert on, and her name is Jillian Sidoti. I'm going to ask her a little later on. Hopefully she'll be willing to either come in person, or if we're still locked down during this whole, give us an online lesson in syndication. Wraparound mortgages, et cetera, okay? We're going to hit a little bit of all of these, hopefully, throughout the year, okay? Now, one thing about the REIA goals, creative real estate in general, the way we do it, only about 3% ever do a single deal, okay? That means now this is nationwide. I'm sure it's a little higher in Columbia based on what I'm seeing, okay? But nationwide, 97% of the people who go into the business the way we do it, never do a single deal. And the gurus who sell these expensive coaching programs, oops, I'm sorry about that. Let me.
Yeah, that's what I'm doing anytime.
Okay. And Andy, You're a special person, so I'll unmute you if that's okay. Okay. As I was mentioning, nationwide, only about 3% of the people get into creative real estate the way we do it ever do a single deal. The gurus who sell their expensive coaching programs, like, whatever you might call expensive, 25,000 higher, whatever. Okay. They know this, but they don't care because they have their money. I have a really bad heart on against people who sell those expensive coaching programs, right? The people who want you to put on your credit cards and stuff. And when you don't do a single deal, you still have to pay the credit cards back or whatever. Okay. I suggest you learn how to do this business inexpensively or even free, and then build up the money you need to buy into coaching if that's what you want to do. That way, at the very least, you're not saddled with the debt from the coaching. Okay. That's just the way I'd handle it personally. If it works better for you by putting yourself into debt, by all means, have at it. Our goals in our association, the Midlands REIA, is to provide more workshops. We've had 3 or 4 of them now already, the rehab workshops with Wade Sabina, Eddie Sabina. Also, more and better subgroups. We do have a couple subgroups. We have to get more active. As I mentioned before, be wary about expensive coaching programs that the gurus want you to put on your credit cards or other places in credit. And our goal this year is to increase the success rate affordably to at least 50% or higher instead of just that 3% for beginners. And this is key here. We want to get you up and running as quickly as possible, independently from anyone else, even us. Okay. We'd love to keep you as members year after year, but at the same time, you might have to move on, or, you might decide, hey, I don't need any REIAs or even Midlands REIA anymore. And we just want you to get up and running independently. Okay. And let you choose, where you go and what you do. For the advanced investors, of course, the ones who remain members, we want to provide the best possible continuing resources. All right. Now, why the low success rate? This is not a hard business. I take it back. It's not a complicated business. It can be a hard business. Okay. It's simple, but it's not necessarily easy, if you will. Okay. I think what happens is there's a very low barrier to entry. It's easy to get in, and so it's easy to get out. Okay. A lot of what we do is easy to do, and it's easy to not do. All right. So you'll see here along this timeline, the path to success and failure looks very similar up until a certain point here. And eventually you'll find success if you're adjusting and adapting in good ways. Obviously, if you're continuing to use bad habits, bad ideas, whatever, it'll lead you to the path to failure. Okay. In this business here, as the markets change, we should always be adapting to how the market's changing. Like, for example, this pandemic, this lockdown, I'm a landlord. Okay. And a few of my tenants have not paid, and one of my evictions got halted. So I have to adapt to that. Now, how does a good club or association help? It might be Midlands REIA, it might be one of the other ones. They offer an abundance of resources, good ones preferably. They provide great networking, hopefully. They give the best training possible, the most up-to-date training possible, and they're always seeking to improve and adapt, as well as the people who support those real estate investors associations should always be learning new things, or up-to-date things, I should say. In the end, it's really nothing's really new. It's just, up to date, if you will. And always trying to teach the best practices for local investing in our area. Okay. That's my personal opinion. All right. That could be wrong. Annual member benefits overview, discounts to national vendors and supply houses for Midlands REIA, discounts on Midlands REIA trainings and workshops. And members, if you've noticed, our workshops so far have been free. All right. Now, these are workshops directly through the association. When we bring in an outside speaker who has their own training, we can't control that. Okay. But the training by our support team, like, Eddie Sabina and whatnot, our contractor and stuff, those are typically free. No door fee to general meetings. And of course, this being an online meeting, there's no fee. But access to the members area with local cash buyers, lists, documents, videos, and other resources, which, by the way, I might as well show you. since I can do this because I'm sitting here now, okay, I've been getting questions about the cash buyers list. When you log in into our website, you'll get a pull down menu here, and the cash buyers are right here. All right. Likewise, you have documents, templates, and calculators here. All right. We're still continuing to add to this site. But anyway, these are where your cash buyers are. Every month I get like one or two saying, hey, where are the cash buyers? Well, this is where they are. Okay. We have like over 50 of them. And we're always continuing to add to them as they come across our plate, across our desk. Close guidance for deals. Okay. This is Midlands REIA only in our area. Okay. Obviously, if it's in like out of state, you know, I think twice. You got to go with somebody out of state there, or even in Charleston or out of the Midlands. Okay, be careful who you're listening to. All right, make sure you can latch on to somebody in that area. But here in Midlands REIA now, I can't talk for other support folks in our association. For myself, though, I'll pretty much talk to anybody, but I do prioritize the members. I mean, I have to, otherwise, you know, I'd never get any sleep. I'd never be able to eat, et cetera, et cetera. Okay. But anyway, if you go to midlandsrea.com, there's a detail of other benefits and what their association does as well. And we're always open to suggestions on how to improve. If you can suggest workshops, new topics, maybe more subgroups, different subgroups to form, please let us know. Okay. If we can do it, we'll do it. And this is the link that goes to our local deal making group. And again, since I am actually in front of a computer anyway, let me go here. You can either go to this link here to get to this group, or you can just go to our website and down off to the right here. Now on a mobile phone, it's going to be different. This link here is going to be all the way down at the bottom. Okay. But anyway, if you click that link, it'll take you right to our Facebook group. And it is a private, is it a closed group or a private group? I don't know. Anyway, if you just click join, now I'm going to assume you're not some scammer from overseas. We got a couple of those, you know, they just created a profile to spam people, then you'll be approved. All right. And there's a decent amount of deal flow going through this group. And this is not the only group, you know, I mean, there's a good number of other Facebook groups that do deals out there. It's all about marketing. Okay, get your marketing out there. And this is, I'd like to think, is a pretty good group to market your deals. And also, if you're looking for private money, this group was actually initially meant to match local borrowers with local lenders. See, here's Andrew Mackby, one of our members, is searching for private money for 2 deals. All right. So don't be shy about asking for private money either in this group. All right. One thing I do caution you, don't post any addresses unless you have it at least under contract. It's a good way to get your deal swiped out from under you. It happened to me. All right. Okay, I mentioned the cash buyers list. Okay, annual membership is $125 a year for single, $200 for a couple, and there's something called REIA bucks. Okay, REIA bucks can be earned when you refer a new visitor to one of our meetings. That's 5 REIA bucks that can be credited towards things like, you know, your membership, your annual membership, and other things that the association has control over in terms of what it might cost. Okay. If that person you referred joins, that's another 20 extra REIA bucks that you can use as credit. Okay. So that's kind of the concept of REIA bucks. A few announcements. We usually have a good number of events to announce. I spoke to John Branham, who's the organizer for the Palmetto Real Estate Investors Network. This month, he's canceling his meeting. And of course, we offered, if he needs to set up a Zoom meeting, we'll be glad to help with that. And also, same with Columbia Real Estate Investors Association. That's run by D'Angelo Laster, Keisha Jones, and Rick Renner. They've also canceled this month's meeting because of the pandemic lockdown. But again, you know, we've extended, you know, help with Zoom, or Zoom if they want to run a Zoom meeting. But again, please keep an eye on, if you click up here, calendar of events, okay, you're going to see a calendar of events, and usually it has a bunch of meetings on there. You can see a bunch were canceled. This is ours tonight, All right. And now there is one meeting showing up. Please keep an eye on this because we're updating this regularly. For example, there's supposed to be a Palmetto Civitan Club meeting. I didn't get details for the Zoom links. I couldn't put it up. But as soon as I get that link, I'll be adding that to the calendar here. But in this case here, this is the Women in Real Estate monthly meeting every third Saturday of the month. If you click that, okay, you'll see who runs it. And keep in mind, this is a passworded meeting. So when you click the link to join their meeting, you need to add that password. Okay, it gives details as to date and time, and it is online. In the future, hopefully, when this pandemic is over, they'll have a physical place, which is typically Panera Bread on Bower Parkway. Okay, if you have any questions, call Stacy Pinkney at that phone number and email. And as I announced before, oops, I'm sorry about that. This is 1 to 2. Okay, see, 1 to 2 p.m. I'm sorry, 3 p.m. online. Okay, so actually, I'm going to make these slides available too. It's not going to be much because really Sean is the one who's dealing with the slides. Okay, anyway, and I hope you get the idea. All right, yeah, as usual. You see I'm kind of correcting this as I go along. It's April 18th. So sorry about that, folks. And sorry about that, Sean. I'll wrap this up relatively quickly here. Okay, it's an online meeting. Please check the calendar of events, okay? Now, for tonight's speaker, we have Sean McKay. He's Senior Vice President of American IRA up in Charlotte. Now, the reason especially that I like American IRA is they will take you by the hand and step you through what can and can't be done, how you'd structure a deal with the IRA. For example, you can throw money at an all-cash deal, but how would you do, say, a seller finance or a subject to a creative deal with the IRA? Sean can step you through the creative stuff. And I'd say most importantly, they're in Charlotte. It's a hop and a skip away from us. All of these other self-directed IRA custodians and administrators, they're in different states, and you gotta, anyway. So Sean's office is right up in Charlotte, and I think they have one in Asheville as well. Okay, so you're quite welcome, I'm sure, to knock on their door and talk to them in person. But anyway, let me turn it over to Sean McKay. As you can see, he has quite the experience with regards to real estate investing as well as using self-directed retirement funds. Okay. Sean, you still there? Oh, wait a minute. I think I might have accidentally muted him.
Hey, sorry about that. Can you hear me, Bob?
Yeah. Sean, if it's okay, let me go ahead and I'm going to transfer the hosting to you. Okay. If you could share your screen and start in on the discussion. Okay. I should say the presentation. And I'm going to try to keep an eye on the chat for any questions that might pop in. Okay.
Okay, perfect.
Okay, thank you, Sean. I appreciate you doing this. Let me make you the host here.
Perfect. Yeah, Bob, I really appreciate the opportunity. Obviously, this is a interesting moment we're all going through, and hopefully everyone's staying healthy. And I certainly appreciate everyone taking time out of their busy schedules to learn a little bit about what we're doing here at American IRA. Apologies, I'm pretty horrendous with technology, so I'm gonna try and get that up and going here. Okay.
Okay.
Is the volume okay?
I can hear you just fine.
Okay. So it looks like it's loading on my screen. Yep.
Oh, okay. It says here you started screen sharing. Okay, perfect. I'm going to mute myself, Sean, okay?
Okay, great. Perfect. Well, thank you so much, Bob. Bob must be a glutton for punishment. I believe this is the third time he's allowed me to share our service with you. So, again, I really appreciate everyone's time and attention. And so tonight we'll be discussing self-directed.
Hey, Sean?
Yes.
I just see a green screen. Does everyone just see a green screen? Yeah, I'm sorry.
Yeah, I just see green.
Could you do maybe a refresh, Sean? Oh, wait. Okay. Okay. That works. Thanks, Sean.
Okay, great. Sorry. So can we see the growing wealth tax-free screen?
Yes.
Perfect. Okay, great. So the topic this evening is self-directed IRAs and 401ks. And if history is any indicator, we probably have a huge range in terms of knowledge and experience with the topic. So for those of you that are familiar with it, forgive me, kind of build a foundation early in the presentation and kind of compound those thoughts and ideas.
Oh,
And
hey, Sean, since you're the host, you may have to mute everybody. I hear some background noise.
okay, let's see what we got here. All right, looks pretty good now. Are we? Is the volume pretty light now, Bob?
Much better.
Yeah, it's all good.
Yes,
Okay,
it's all good.
Great. Perfect.
Thank you, Sean.
Thanks. Appreciate the patience, everyone. Okay, so again, we're going to discuss self-directed IRAs and 401ks this evening, and we'll delve right into it. So historically, when we think about the capacity to retire, to not have to go to the job every day, historically what we've learned about is the legs of the table. There's a few components that allow us to not have to work the W-2 or the 1099 wage if we choose not to. And so the first component to that has historically been pension plans. And so certainly many of us are aware that unfortunately that pension plan concept that previous generations had, where you were able to work for a company for 20, 30 plus years, and that company would pay you a income stream essentially in your retirement, has essentially gone away. Companies, unfortunately, are no longer doing that. So that's effectively a leg of the table we have to remove. The next is Social Security. And I am by no stretch of the imagination the brightest crayon in the box, but I think we're all aware that Social Security in its current form is really in trouble. I was reading an article actually yesterday where it mentioned we're now in a deficit for the first time in decades in terms of money being put into the Social Security pool each year in comparison to the money that is being taken out by those that are eligible to pull from Social Security. And the projections are that in the next couple of decades, they'll have to drastically cut the amount that is being sent off to those in their retirement years. And so obviously that's a little bit dim of a prospect. And again, I'm an optimistic individual. There's a lot of great things happening, even in this kind of challenging pandemic period. I'm a true believer in our resources, our ability to thrive. But I think the Social Security bucket is certainly not one that we want to rely on heavily. The next one is personal investments. To me, probably the best part about my job is the ability to learn from and spend time with really successful entrepreneurs, real estate investors, people that go out there and make things happen. And I used to really strongly believe, and I would say so in my talks, that frankly, if you've built the portfolio of rental properties or whatever the businesses that you've created, you probably don't need retirement accounts or self-directed retirement accounts because you've kind of made it. You've kind of reached the top of the mountain. And largely that can be true. I think that what we should all kind of appreciate, though, is I'm the first one to admit I certainly do a pretty significant amount of investing outside of my retirement account. But inside the retirement account is a special vehicle because these IRAs and 401ks are trust accounts. These are vehicles that I have to preface this by saying I'm not an attorney, but every one of you in conversations with your attorneys, with your CPAs, will find that these are the best vehicles for asset protection. So personal investments are tremendous. However, many of us hold, let's say rental properties, for example, we might hold all or the majority of our rentals in a single LLC. And what if, God forbid, there were, some sort of slip and fall, some sort of catastrophic accident, and the courts are able to pierce your corporate veil and the family that was the victim, if you will, of the incident at your property is then able to work through the assets that are held inside that LLC. That can be really devastating financially, emotionally, and all of those things, certainly for us as investors. So for me, that IRA and 401k concept is a way to completely differentiate your personal investments from your retirement account investments in a way where if something were to happen in your personal LLC, they're not going to be able to attach your retirement account assets. So it's a truly unique vehicle. And certainly the IRA and 401k being the last leg of the table is obviously what we'll spend the majority of the evening discussing, the benefits and what have you. So when we look at what the quote unquote average individual in America does with their IRAs, their 401ks, their retirement plans, they're invested in some variety of products, of financial products that we're able to purchase from banks, from financial advisors, from online institutions that are considered securities. So that's typically stocks, bonds, mutual funds. Sometimes we're investing in annuities, money markets. We're all pretty familiar with a lot of the options available to us there. And I'm the first one to say those can be tremendous vehicles. I have the utmost respect for our partners, if you will, in the financial services arena, the deal with securities. There's a lot of great advisors out there. There's a lot of great resources. Ultimately, this evening, what I'm here to do is just simply make you aware of a wider array of investment options available to you with your IRA and 401k. So when I think about the stock market, an argument that I have actually with my dad on a regular basis, he was an advisor for over 35 years, is kind of the pros and cons of the stock market world versus the alternative asset world. And obviously we're a group of real estate investors, so we'll kind of condense that to the real estate world. So the first challenge I have with the stock market is, again, I'm not the brightest crayon in the box. My dad's this advisor. He was the best man at my wedding, so you can't say we're not close. But ultimately, I still, at 36 years old, a lifetime of being able to learn from my father, I don't feel as though I am a competent stock market investor. I actually go through the process of reading annual reports for companies. I dig into mutual funds in terms of their holdings, and I still underperform the market all the time. I've gotten to a point where all I can do now is just invest in index funds because I've just realized I'm a dope. The challenge is I think a lot of us kind of fall into some form of that category where we're certainly less competent in understanding how to analyze the stock market and those companies in comparison to our ability to invest in real estate. You know how to drive a neighborhood, analyze the comps. It is something that is, in my mind, a cleaner analysis as opposed to all the variables associated with the stock market. So again, not to say that it can't be very useful for you, but we need to invest in what we actually understand. The second component that's always been a real challenge for me with the stock market is the cash flow. And so Bob actually touched on it earlier. We're in really challenging times right now. It's a pandemic. Unfortunately, a lot of people are unable to work. And obviously, even more unfortunate, people are getting sick. And so there's a real challenge in our world today. And as I actually looked at my statement for this month a couple hours ago, the property manager sent out the monthlies, and 80% of my tenants have paid full rent for the month. And so what that means to me is that the cash flow from real estate, even in these very challenging times, can be more solid and more predictable than the cash flow in the stock market, because for one, the stock market cash flow is limited. So if you look at someone that has a $500,000 portfolio of stocks, a lot of people would say, and I would agree, that that is a substantial portfolio. It can take someone a lifetime to create that much wealth through stocks, mutual funds, etc. And if you look at an average yield of, say, 2%, which is kind of what index funds, like a broad index fund product will produce, that's going to give you about $10,000 a year in income or $833 a month. So for those of us that have rental properties, that equates to essentially one paid off property that we're renting for $1,500 a month, because I use somewhere in the ballpark of about a 40 to 50% expense ratio for your taxes, your insurance, your vacancies, capital expenditures, etc. So to me, I look at it and I say, if in our lifetime we're able to buy a handful of properties and over time work to get them paid off, that can be more prolific from a cash flow standpoint than a really substantial portfolio of stocks and mutual funds. So ultimately, obviously, I don't have to sell people on the idea of real estate, but ironically, so many real estate investors still have their IRAs and 401ks invested in mutual funds just because they're unaware of the self-directed concept that we're going to discuss tonight. So obviously, again, we're all real estate investors. We love real estate. But to me, what's the one challenge with real estate when we do these deals in our personal name or through our LLC? For me, it's the idea of taxes. I'm almost purely a buy and hold investor, but there are situations where I've missed the mark on a neighborhood, for example. I thought it was a little bit more stable than it ended up being. It's a property that's just been challenging for me. I just had a run of bad tenants, and the property just leaves a bad taste in my mouth. So I want to move away from that property. And as many of you know, if you do that deal outside of a retirement account, the only way to actually defer taxes typically is to either do a 1031 exchange, which I'm sure you guys are familiar with, and Bob has maybe even brought in resources to talk about selling a property and exchanging into another property and deferring taxes. And the other way is, not to be morbid, but you pass away. You keep that property for your life, so you don't have to pay taxes on selling that property. So tonight we're going to talk about whether it's rental properties and selling them and not wanting to recapture depreciation and pay, the appreciation that you've seen from purchase to what you're selling it for, or even for those flippers or wholesalers that want to kind of take some of the pain that they feel out of the tax bill for doing their real estate deals. These self-directed IRAs and 401ks are a really interesting and unique concept for us to consider. And we all talk about tools in our tool belt. We have the ability to wholesale, to flip, to buy rentals. We use different strategies, seller financing, walking mortgages, different things like that. Those are all great tools. And I just ask you to consider this as a tool for some of you to consider in your real estate investing. So when we define a self-directed retirement account, I break it down into two fundamental components. The first is, as the name indicates, this is a self-directed account, meaning you as the account holder will be picking the investments for your portfolio. So again, we are not advisors that are sitting down with you and kind of doing this analysis of where you're trying to go and then selling you products such as mutual funds, annuities, etc. You are the complete decision maker as to where you're going to be investing your IRA or 401k. The second component is when we talk about a self-directed account, the securities world has done a great job of educating us through groups like Vanguard and Schwab and TD Ameritrade that you can go through their online platform and you can pick your own securities. You can pick your own index funds and stocks and bonds, and that's a great vehicle, again, for us to consider. However, in my mind, that's not a completely self-directed account because you're still relegated to those products that they have to offer you. So while you can still invest in the stock market under our American IRA umbrella, most individuals, most investors are coming to us because they are wanting to invest in assets such as real estate, such as being a lender, all the things that we're going to kind of unpack this evening. So from a benefit standpoint, when you think about it, again, tonight we're just simply introducing the same investments that you've been making, but doing it in a more tax efficient manner, either tax deferred or tax free. depending on the type of IRA or 401k you have. As I mentioned earlier, asset protection is a really valuable tool when you most need it, because these are, by definition, trust accounts. And for those of you that are willing to tolerate me, for the length of this presentation, I do have a bonus section where I speak about just some very common sense, helpful concepts that I've utilized for raising private money. Ironically, I have a uniquely small pool of people that I can work with, because I cannot work with our clients and raise money via their retirement accounts. And I've been very fortunate to have a lot of, good people that I admire and that I've learned from become clients. So they then become people I cannot do business with, which can be a little bit challenging. So we're hopefully going to add some value to tonight in a variety of ways. So at American IRA, we are what's considered a fully integrated self-directed firm. And so what that means is that self-directed administrators, which is what American IRA is, we are reliant on third-party companies to be able to stay in business, a trust company, a custodian. And so the challenge is most administrators are reliant on third parties outside of their group to allow them to stay in business. So you have a completely separate trust company or custodian, and if they give you a 30, 60, or 90-day notice saying they're no longer interested in being the custodian for your company's assets, you have to scramble to go and find a new custodian in order to be in business. So again, we're fully integrated. And so what that means is that our principal at American IRA also created a trust company so that we are not reliant on other firms to be able to stay in business and provide services to our clients. So that gives us a sense of safety as employees, and certainly Jim as our principal, and then also our client base not having to worry about us scrambling for new trust companies and different processes and what have you. So it's allowed us to have kind of smoother sailing recently in comparison to some of our competitors. Now, at American IRA, we're set up very differently from a fee standpoint, in that most self-directed firms have one of two models. Either they charge you an additional fee per year per asset. So for example, very commonly in our industry, firms will charge about an extra $300 a year per asset. So let's say you own 3 rental properties, you're going to pay at least $900 a year to that self-directed firm. The other model is, as your account balance grows, so does your annual fee. So the $50,000 account might be about $300 a year. The $500,000 account could be a couple of $1,000 a year. A lot of these companies max out around $2,000 or $3,000 for their annual fee. Our premise is that since we're not picking the investments for you, we shouldn't get to see the upside. So once your account balance hits $7,500, your annual fee is frozen for the IRAs at $285 for our annual fee. And I'll touch on this at the end of the presentation. But it's just a very, very different model in that we feel like we should just be paid for the services rendered, not for your ability to grow your retirement account. Now, the nice thing about our firm is that we have a lot of really intelligent, really competent people. We keep those people in Asheville. I originally worked there until they realized I was not one of them, and they sent me off to Charlotte. But we have a great team that is really doing a tremendous job processing and working with clients through their particular investments, as Bob mentioned. And we have a very senior staff. You see a lot of turnover in the self-directed industry. People are with the companies for a year or two, and then they're with different companies. And with us, our senior team has been with us 8, 10 plus years. I've been very fortunate to be with our firm for almost 12 years now. And so there's a lot of continuity and a lot of experience. As Bob mentioned, I am definitely a real estate investor myself. I love this world, I love this space, and I love getting to learn from other real estate investors. So this isn't theoretical discussions, we do these deals ourselves. So when you look at a self-directed retirement account, try to keep in mind, self-directed is really just a marketing term that the industry uses. You're still going to have your same IRA or 401k product. So if you have a traditional or sometimes called a rollover IRA with Bank of America, for example, and you decide to move all or a portion of that to us, then you're going to have a traditional IRA with us at American IRA. Same is true with the Ross. All the other accounts that we administer stay in their same form. The one time where that will typically change is if you have an old employer-sponsored plan, such as a 401k, a thrift savings plan, a 403b, something that the company created for you, that will then be typically rolled over into another pre-taxed account, such as a traditional IRA. As you can see, we also have accounts such as health savings accounts, Coverdales, inherited IRAs, and 401ks as well. And for those of you that are small business owners, I did a webinar today at noon where we really dug into the solo 401k concept, SEPs, Simples. These are all retirement accounts that you can utilize and self-direct as well. So basically, any type of retirement account can in fact be self-directed. So as we look at the options available for us with the accounts, really the way the IRS code is written, and we'll cover this later on, is it simply tells us what we cannot invest in. So this is by no means a complete list of what you can invest in with your IRA or 401k. But as we look at real estate and focus on that this evening, essentially with the IRA, your IRA or 401k can directly own anything from raw land to condos, townhouses, single family homes, commercial buildings, apartment complexes, industrial buildings. Any type of physical real estate can be owned by your IRA or 401k. Now, there's also the ability for the retirement account to be the lender. And so lending is going to come in one of two general formats. It's either going to be a secured or an unsecured loan. And so with the secured loan, that will be a deed of trust or a mortgage. Obviously, South Carolina being a mortgage state, North Carolina conversely being a deed of trust state. So you are securing your retirement account money by a specific property, and that investor borrower is going to be making payments back to your retirement account. And we'll touch on that this evening. And then conversely, unsecured notes is just simply where the IRA or 401k is lending money to some other individual, some other investor, and they understand there's no technical security. So if things go sideways, you may not be able to recoup any of the principal that you've lent out. So obviously that can be a little bit riskier of a loan, quite frankly. Tax liens and tax deeds. Some of you may be aware, every state is a little bit different in the way that they're structured. If they have tax lien auctions, I went to one in South Carolina a couple of years ago. I had some success back in Florida with that. I went to a live auction, and there were a couple of big dogs there that were just buying everything. And so it was basically, we just got to watch the hedge fund guys go at it. So please correct me if I'm wrong, but last time I was, I guess you could say, participating in it, it was a live auction scenario in South Carolina, as opposed to an online concept as you have in places like Florida, for example. And LLCs, we get asked a lot about our LLCs. Do you guys have checkbook control? Do you allow for IRA or 401k owned LLCs? And so yes, that is something that you can do with your retirement account. It can be a single member IRA or 401k owned LLC, or it can be a multi-member LLC. And Bob spoke about the concept of syndication earlier. We're seeing over the last few years, especially, a tremendous amount of syndication deals. So I just put together a very vanilla syndication concept just so that we can see the basics of how that could interact with the retirement accounts. So as we dig into the real estate strategies, we'll touch on most of these, if not all of these tonight. But basically, the way to think about it is if your IRA or 401k is going to invest in a real estate investment, whether it's the debt or the physical ownership, It just simply needs to be for investment purposes. So there might be some of you that are die-hard landlords. You like to accumulate rental properties, fix and flip. For those of you that especially work the off-market deals with wholesaling and options on properties, these things can all be done with a self-directed IRA or 401k. And joint ventures really is just, as many of you are aware, just the idea of the retirement account, in this case, partnering with other entities, other resources, and just simply owning a portion of an asset, such as a single family house, an apartment complex, whatever the investment may be. Private lending, sometimes called hard money lending, basically just simply being the bank for other investors. And at the very end, I'll just kind of touch on a scenario of how you can actually purchase a property that you want to utilize and actually be able to enjoy in your retirement years, how you might want to consider purchasing it initially with your self-directed IRA or 401k. So as we look at the deals tonight, the first thing we should feel pretty comfortable with and have an understanding of is disqualified persons and entities. So we start with you as the account holder. So I, Sean McKay, have a self-directed retirement account. I better, right? If I'm doing these talks and I'm not actually doing these investments, although that does tend to be the industry standard. So I, Sean McKay, I have a self-directed IRA. I cannot buy a property from, my IRA cannot buy a property from myself, from my spouse, from my children, if they are to ever get married and have spouses, grandchildren, their spouses, great-grandchildren, their spouses. So the downline also includes spouses. The upline is just simply your actual ascendants, so your parents, your grandparents, your great-grandparents. And entities that any of these individuals own or control are part of a disqualified persons group. And so again, if any of these individuals or LLCs that these individuals own or control, they're not going to be able to sell a property to your retirement account. They cannot buy a property from your retirement account. There cannot be any lending back and forth between these individuals and the retirement account. And these individuals cannot provide services to an asset owned by the retirement account. And I don't know why. Whoops. Okay. So apologies. We kind of got some stuff spliced together. But essentially what the next slide should have been, apologies, is talking about the services. So disqualified persons cannot be the realtor on the transaction. They cannot be the closing attorney. In some states, the escrow agent, the firm that is actually closing the real estate transactions cannot be a disqualified entity. And then also a big one is going to be the sweat equity. So if you're a really handy person and you're used to putting roofs on or, framing properties and doing all sorts of that work yourself, unfortunately, you cannot do that if the property is owned by your retirement account, nor can any of your other disqualified persons or entities. So a pretty common question we get is, can I purchase a property with my retirement account and then have my child rent that property from my retirement account as they're going off to college, for example? So since the child is a descendant, they are a disqualified person. And so even if they're paying fair market rent, even if you're going to be hands off with the sweat equity and what have you, unfortunately, that is a prohibited transaction. So you got to be very careful how these individuals interact on deals with the retirement account. So as you think about kind of the general process for these deals, essentially it's identical whether you're purchasing stocks or you're purchasing real estate with your retirement account. Before you do anything, you need to first open and fund your retirement account with whatever firm you're going to need your financial relationship. So again, it could be Vanguard for index funds. Hopefully it's American IRA for your self-directed retirement accounts. The next concept is to go hunting for your deals. You're looking to do wholesale deals inside your retirement account. You're going to buy rentals. You're going to be a lender for other investors. Whatever that strategy is, once you've identified a potential opportunity, you'll speak to us at American IRA about what the flow of the paperwork looks like so that your IRA or 401k can participate in that particular investment. And then the net end result is that your IRA or 401k actually owns the asset. So it owns the rental property, it owns the property that will be a fix and flip, or it owns the loan that is being made to the other investor. So the IRA or 401k is the actual owner. So when I think about our client base, to me, there's kind of two categories that I see. I see first the diversification clients. And so these are individuals that are certainly still going to be maybe even heavily weighted still in their stocks, their bonds, their mutual funds. They're going to stay in that securities world. And they might have the bulk of their money with a financial advisor still, or with a Vanguard or one of those groups. But ultimately, they're looking to completely diversify their portfolio so that when these moments hit, there's hopefully some assets that perform better than others for their portfolio. The stock market in the last 30 days has been, from top to bottom, it was 35% decline. It's come back up a bit. It's been kind of a wild ride. And so maybe you're going to be able to sleep a little bit better at night if you also own a rental property, in addition to your mutual funds and your individual stocks and things of that nature. So we all have different preferences and what have you, but this is the diversification group. So we're going to go through just some very, very simple deals that I'm sure everyone in this group has the capacity to do if they're not currently doing. So Susie Saver is just simply looking to create a better stream of income in her retirement. So the bank products, as we all know right now, with CDs and money markets, aren't paying anything. She likes the idea of real estate, but she's not going to go out there and send out mailers. She's not going to door knock. She's not going to do the entrepreneurial stuff that Bob was talking about that's maybe not complicated, but it can be difficult to make yourself do and to put yourself out there like that. So she decides she's going to be a lender. So for those of you that are out there raising money, again, we're going to kind of weave this concept in throughout the talk tonight, is that IRAs and 401ks are a tremendous vehicle for raising money for your deals, whether it's to buy a single family house or a 200-unit apartment complex. IRAs and 401ks are a great source of capital. People tend to be a little bit more patient with their IRA and 401k investments. They're not trying to get many times some incredible yield, some incredible return year to year, excuse me, with these investments. They're simply looking for, typically safe and steady. And especially if they're not real estate entrepreneurs themselves, you'd be stunned by what terms people will find to be agreeable if they're just simply looking to beat CDs and money markets. So on this deal, the IRA is going to lend on a very vanilla fix and flip. It's going to be a $100,000 loan, 12% interest, 1-year term, and the loan is out for 7 months. So Susie's IRA makes $7K in a tax-deferred vehicle because she has a pre-taxed IRA, such as a traditional or a SEP IRA, for example. Very, very simple. So again, this is actually where the slide left us earlier. Apologize. So when you're looking at these deals, again, make sure that we're as passive as humanly possible. We're not the realtor, the closing attorney, providing sweat equity when we're looking at this next concept, which is purchasing rental properties. So full-time Frank works a very full-time job, 60 plus hours a week. He has what many of us have with job and family and social obligations, but he's seen the statistics about how wealth has been created over and over again in our society by owning real estate. And so Frank is going to do a very, very, very vanilla deal that, again, I'm sure many of you in this organization are capable of doing. He's actually just simply going to work through a realtor to find him a deal on MLS, and his IRA is going to make a cash purchase. So the all-in cost in terms of purchase and rehab will be about $120,000, and the property rents for $1,000 a month. So the cash flow to the IRA might be somewhere around $500 to $600 a month. Again, once you factor in taxes, insurance, management, maintenance, vacancies, all those goodies, that's going to give you a cash flow number. And certainly that net operating income that we just spoke about, the 500,000 or 600,000, if there was a mortgage on the property, then the mortgage payment would come out of that net amount to pay the principal and interest. So these IRAs and 401ks can do these very clean, very easy deals. And then certainly, as I'm sure many of you are doing far more advanced deals, those can be executed as well with these accounts. So as you think about strategies with these self-directed accounts, to me, I break it down into 3 general concepts that we see from our clients. So the first is that the IRA is going to be the sole owner of the property or the sole owner of the note, and it is going to lend or purchase a property. In this case, it's going to buy the property, and it's simply going to pay cash for this property. So in that last example, full-time Frank had all of the money in his account plus reserves to just simply do a cash acquisition. Option 2 is where the IRA or 401k actually partners with other individuals, other retirement accounts, other companies, and does kind of a tenants in common or a joint venture type of arrangement. So the interesting thing, and I know we're kind of going to go to the next level with this concept, is the IRA or 401k can actually partner with a disqualified person that we spoke about a few minutes ago, as long as it's on the initial acquisition of the asset and the ownership is split pro rata to what both parties are bringing. So let me give you an example. My wife and I own LLCs for our rental property holdings. So let's take a LLC number 1 could partner with my IRA or my wife's IRA or both of our IRAs to do a particular deal. We could all partner to make a loan. We could all partner to do a fix and flip, whatever the strategy is. Again, everything would be split pro rata. So if our LLC brought 40% of the money to the transaction, it would have a 40% ownership. It would be responsible for 40% of the expenses, and it would get 40% of the income. The other participants would get their pro rata ownership as well. So disqualified persons can partner together at the initial time of acquisition. So it would need to be cleanly stated, even on the initial offer to purchase, what each party's percentage ownership is of this asset, of the loan, of the ownership of the property, etc. So that's concept number 2, is partner. Concept number 3 is where the retirement account is actually going to use leverage to do a deal. So an IRA or 401k can actually borrow money. Typically, from a practical standpoint, it is usually to acquire a rental property, something that will produce cash flow to be able to service that debt. And so the IRA or 401k can use a couple of different mechanisms. So Bob mentioned earlier seller financing, which, as we all know, is a tremendous tool, especially if you get to work off-market deals. So the IRA or 401k can make a down payment to that original seller. Let's say it's a $5,000 or a $10,000 or $20,000 down payment. And then that seller can agree to finance the remaining portion with whatever terms are agreeable for all parties there. And so as the IRA or 401k rents that property, the cash flow produced will hopefully be enough to cover that mortgage payment to that seller. So seller financing is in play. There's also some institutional money that will lend money to IRAs or 401ks. The key when we're speaking about using leverage is that it needs to be a non-recourse loan to the account holder. So for example, again, Sean McKay, I have an IRA. If I elect to use a mortgage inside of my retirement account, then I cannot personally guarantee the loan. So the lender must understand, in case of a default or a foreclosure, the only thing that they can recoup is just simply the property itself. It cannot sue the retirement account. It cannot sue you as the account holder. It is just simply making essentially an asset-based loan. So as you can imagine, There's fewer lenders that are lending non-recourse as opposed to the typical recourse loans that most of us sign if we use a mortgage to buy our personal residence, or the LLC loans that we typically get, commercial loans, what have you. Those are not typically non-recourse loans. So the next concept is a fund or a syndication deal. Again, Bob's going to bring in experts that can really dig in super deep, but ultimately this is just kind of give you really broad strokes of how this works. So Wealthy Will's had the successful corporate career. He's got the IRAs, he's got the 401ks, he's networked in different REIA groups. And again, like a lot of us, he's a busy guy. He's still got the career going. He wants to be in real estate, but he's got to be really passive with it. So ultimately, Wealthy Will decides that he's going to actually get involved in two types of syndication deals. One is going to be a lending syndication, and the other one is going to be a partial ownership of an apartment building. So with the lending syndication, typically what you find is that the return on investment, the cash flow each year on lending syndication deals operated properly will be a little bit higher typically than a fund that goes and purchases an apartment complex. Typically with an apartment complex, there's a value add. It's a property that needs a lot of TLC. It's going to need to be repositioned. They're going to need to kind of work through a new group of tenants that can pay a higher rent roll, et cetera, over the next couple of years. So typically the cash flow is a little bit less, but the thought with the ownership fund is typically that the thought is they're creating equity, they're paying down the mortgage over time, and if and when they exit that property, there should be equity split amongst all the owners of the group. And obviously, for those of you that are familiar with syndications, there's almost endless ways that syndications can be structured. But I think this is something, again, that we're seeing a tremendous amount of over the last couple of years with all the syndications out there, all the online networking, and all the different platforms people have to share the investments that they're working on. So kind of interesting. So with these syndication deals, long story short, the retirement account will become a member of an LLC. And that LLC will then own the apartment complex, or the LLC will be making loans to a number of borrowers, and then the money's flowing back to the LLC. Many times they're distributed to their investor base on a quarterly basis, sometimes an annual basis. And so that flows, again, back to your retirement account, not to you as an individual. So the next concept is just simply the strategy experts. So again, there's a lot of you out there that are experts, whether it's as landlords, as wholesalers, just kind of the transactioneers as they are, with just doing a lot of creative deal structures off market. And again, I love learning from those of you that are those experts. So I always wish I was the guy that's listening and not talking. And you might be wishing that somebody else was talking as well. But here we go. We're doing fix and flip here. So Hustler Heather has a construction background, and she's out there in her day-to-day business actually flipping houses. She knows how to put the deals together, analyze the neighborhoods. She understands the retail values, and she's doing really well with that. She's making a great living. However, she's realizing that she's not putting money into tax-advantaged accounts. She's not kind of putting enough aside for her future, where she might not have the energy that she currently has to do the 20 or the 40 flips a year. So Heather locates a property. It's going to be a very nice, easy, clean, small deal. Her IRA is going to purchase a property for $50,000. It's a very light paint and carpet, maybe an appliance or two for $10,000. And the property takes 6 months to sell. So the key is that the retirement account, Heather's IRA, will be paying any and all holding costs. So the utility bill each month, her IRA is going to be paying the hazard insurance. There's going to be a proration of taxes at closing that the IRA is going to pay. If there's an HOA associated with the property, Heather's IRA pays that. So all of these concepts will be paid for from the retirement account. A buyer comes along and purchases the property for $95K from Heather's IRA. We'll assume she put it on the market. Heather's IRA hired a realtor to list it. Realtor's commissions are paid, and then the net proceeds flow back to Heather's IRA. So the next is a wholesale deal. And so with this relationship, Randy, is every REIA that I have the privilege of spending some time with has a number of individuals like a relationship, Randy. They're always out there just talking to people, hearing what opportunities are out there, and they come across some really interesting deals. And so this time, Randy came across a deal that we see a lot of these days. It's a package deal. Now, with this deal, Randy's IRA is going to be wholesaling this property. So it's really, really imperative that if your IRA or 401k is going to wholesale a property, that you must make sure that whatever agreement you put in place with the seller, with the owner of the property, it is actually your IRA or 401k going under contract, not you or your LLC, with the assumption that you can then later assign that contract to your IRA or 401k, and then later on assign that contract to another investor. The IRS does not understand assignments whatsoever. So please make sure that if your retirement account is going to assign a contract, that you call our office, you go to our online platform, whatever is more convenient. We'll give you the verbiage for your account so that it's actually your retirement account going under contract. And the other key is there must be earnest money. I realize some of you can do a deal on a handshake with sellers, and maybe you don't even have to put money down. Again, the IRS does not want to see an infinite rate of return. And so if you turn $0 into a $30,000 assignment fee, that will blow their minds. They do not know what to do with that. And that will be an issue for your retirement account. So you must make sure that there is some skin in the game. There's some earnest money associated with this deal. So relationship, Randy found a burnt out landlord. We're all there sometimes. And he negotiated to purchase 20 units from this landlord. This could have been a 20-unit building. This could be 20 single-family houses. Ultimately, each property, this was 20 single-family houses. Each property was under contract for $80,000 between Randy's IRA and the owner of the property. They're each worth about $100,000. Randy's IRA is going to mark up each property $8,000. So basically selling it to an end investor, in this case a hedge fund, for $88,000 a piece. Now, Randy was smart. He made sure that his IRA went under contract for each property with the seller, and that there was $1,000 in earnest money in consideration that went into this deal. So 20 units, a total of $20,000 that Randy's IRA had exposed with the seller. And so again, the key there is a cash buyer came along. Certainly for those of you that work with buyers that are getting bank loans, it can be really challenging from a seasoning perspective to assign those contracts. So in this case, Randy's IRA sold to a hedge fund cash. And so as you look at the deals, the package as a whole was 1.6, and the assignment price was $1,760,000. So basically, he was able to utilize the $20,000 in his IRA to create a $160,000 profit to his IRA or 401k. Now, what I will say about transactional deals is that you want to be very careful and in constant communication with your professionals, your attorneys, your CPAs, your tax and legal team. Every CPA has a different analysis as to how much transactional activity they will allow essentially inside of your IRA or 401k before it starts to look too much like a full-blown business, in which case there can be a tax consequence even for these retirement accounts. I get this question every day of my life, and I know it doesn't make me sound terribly intelligent, but I do not have an answer as to what the magic number is. Can I do 10 flips a year? Can I do 30 flips a year? Every CPA has a very, very, very different analysis as to what's the threshold before you're running a quote unquote business inside of your retirement account. So if you are someone who is heavily transactional, especially, you really do want to have conversations with your tax and legal professionals as you're going through your self-directed investments so that they can give you some guidance as to what they feel comfortable. Because certainly, as you know, if there's an audit situation, if there's a challenge with any of your personal, your retirement account, taxable situations, that CPA has to be comfortable in articulating on behalf of you or your retirement account their analysis as to what's transpired. Now, we're kind of talking about a lot of different things tonight that are certainly beyond the typical stocks, bonds, and mutual funds with retirement accounts. And so pretty regularly, we kind of get these frustrated individuals that say, my advisor, he never gave me this information. He didn't let me know I could buy a property inside my retirement account, or I could invest in a privately held company. And there's sometimes a bit of anger there. And again, I have a lot of respect for that industry. They're doing the best that they can largely. And they're individuals that are selling you products when they're working for these securities firms, for these banks. And so many times they're not educated on these alternative assets, one. And second of all, with these individuals, many times they will actually be fired by their company by doing what's called selling away. They're making you aware of investment opportunities that their company cannot assist you with. So it's not that they're trying to be misleading or not helpful. They just have certain regulations and restrictions that they must follow in terms of their industry, in terms of the organization that employs them. So try to be a little easy on them if, again, this is kind of a new concept for you and you're just wondering why you're just now hearing about this. And so I believe the last one is Danny the Dreamer. And so again, this is the idea of buying, in this case, a condo using his Roth IRA initially to make the acquisition. So in this case, the property is purchased for $300,000 utilizing a Roth IRA. And prior to retirement, Danny's IRA is going to hire a property manager to rent that property. Obviously, we have some great coastal areas. Some areas allow for short-term seasonal rentals. And so ultimately, his retirement account can be actually creating a stream of cash flow by renting this property via the property manager. It could be short-term, it could be seasonal, longer-term, et cetera. And so Danny's IRA can actually be being built up by the rental income with this property. Now, in Danny's retirement years, though, he actually wants to use that property for personal use, which you cannot do if your IRA or 401k owns the property. And so he decides, and again, you really want to sit down with your CPA to structure this, but he decides to distribute the property. So it goes from being owned by him, his retirement account, to being owned by himself personally. And again, because it is a Roth IRA, assuming he had that account for at least 5 years and he was 59 and a half when he distributed this property, it doesn't actually matter what the property is worth. It could be a $600,000 condo at this point. He will not pay taxes because it is the Roth that distributed the property. Now, conversely, if you do the strategy with a pre-taxed account like a traditional IRA, that's a more complicated tax structure. Typically, CPAs will advise their clients to distribute it over a number of years to kind of mitigate that tax consequence. So, there's a lot that can go into that. But this is something where we're seeing clients, they buy the place on the beach, in the mountains, on a lake somewhere. We're very lucky in the Carolinas to have a lot of beautiful places. So this is something that, again, we're starting to see more and more of. And so for those of you that have not fallen asleep to this point, again, really appreciate everyone's time. I'm just going to kind of run through just some pointers that I've seen raising private capital, because we see a lot of individuals that want to raise money from individuals. They don't want to go to the bank. But I do find consistently that sometimes there's a little bit of a lack of preparation that goes into the process of raising money. Sometimes they'll make a phone call or talk to someone at a meeting and it's just, hey, I got this property, not really sure how much I'm going to put into it, not really sure what the comps are. And, we've all kind of seen those stories before. And so I've been really, really fortunate to be around, again, some very intelligent and successful people. So I'm really just regurgitating what I've been lucky enough to learn. But there's something that one gentleman calls a credibility packet, where essentially he puts together a group of documentation to show to a prospective lender. And to me, it accomplishes a few things. One is it makes you look far more professional than many of the real estate entrepreneurs that are out there trying to raise private capital, especially for a one-off deal. I'm going to buy a little single family house, etc. Syndication world is a little bit different. That's usually a little bit more buttoned up. But for those that are doing just the onesie twosie flips or rentals, you don't always see a lot of this stuff. So the cover page will just simply show the macro of the opportunity. This is the property, maybe a nice picture of it. And then ultimately, you're going to kind of build this case for why you're a competent individual to work with. And I was using this in my 20s. I was not making great money yet at American IRA. Because I didn't deserve to make great money, I wasn't adding any value. But I was not really at a point where I was bankable. I needed to get a little bit more creative on deals that I couldn't get seller financing on. So the suggestion was you build out your financial strengths element. You show hopefully a good credit score. Hopefully you show that you have some savings in the bank. And you show a little bit of a real estate resume. And it could be as simple as I'm attending, these groups. I've gone to these functions, and I'm working with so-and-so in town that we all know is a respected investor. You're really just showing them that you're taking this serious. This is a business for you, and you really want to be successful with this. And then the next concept is an Excel document, and it has 3 tabs to it. Very, very simple. My wife was doing this. She's the engineer, so she could whip this up in about 15 minutes. It would have taken me about 15 weeks. But the first tab is just sold comps. So you come up with some really reasonable sold comps to the subject property that you're looking to acquire, you're looking for additional capital for. And then ultimately, you kind of come up with essentially like a very boiled down appraisal concept for the comps. The next tab is going to be a breakdown of the repairs. So you literally you could do something as simple as a line item. I'm going to put in HVAC. That's going to be $4,000. I'm going to put in a new roof. That's $5,000. It's 1,500 square feet. I'm going to pay, whatever, $2,000 in paint. You just kind of lay out all these elements so that they clearly see what the scope of work is going to be. And especially important if they're actually the type of lender that wants to walk the property with you. If you have just a couple of things on a piece of paper and the lender walks through and they say, well, we got to completely gut the kitchen, we got to completely gut the bathrooms, doesn't look like you're paying attention here, that could be a deal killer. And then the third tab is just simply a financial analysis for the property. So my wife and I, we've again always focused on rental properties outside of our retirement accounts. Inside, we tend to like being the lender and working kind of shorter term deals. And so when we were raising money for our rentals, ultimately we wanted to show how this property is profitable, how we could afford to pay them for the use of their funds. So we would run a very conservative net operating income. You start with the gross, you subtract the vacancy, you have an adjusted gross income, and then you're going through and you're taking out the taxes, the insurance, the conservative numbers for capital expenditures, et cetera, to show them how you still believe that this property can at the very least pay for itself. So again, I'm no expert by any stretch of the imagination, but certainly for those of you that are just getting started in raising money, maybe there's some value in there for you. So as far as our fees go, again, very quickly, we have free cash accounts for our IRAs. So you open your account, you put maybe even just a few $1,000s in, maybe you're moving over at some point an existing IRA or 401k. That IRA with us, you're not going to get charged your annual fee until you make your first investment with us. So it could be weeks, months, years before you're charged the annual fee for the IRA, because again, you might wait that long to make that investment. Again, Bob's always been really, really generous in allowing me to communicate with this group. And so through the end of the month, certainly I'll be happy to waive the setup fee, which is typically $50 to open the account. The annual fee for accounts less than $7,500 is $165. Again, if you're actually actively using that account. If your account is over $7,500 plus, then your annual fee for IRAs is $285 a year once you start to make investments with that account. Now, we also have a transaction fee. The bulk of our work is done when a client buys a property or when they sell a property. So a single transaction, which is either a purchase or a sale of an asset, is $95, or you can do unlimited transactions for $165 a year. Beyond that, we just simply have bank fees. So outgoing checks are $10 check fees, and wires incoming and outgoing are $30 fees. So again, really appreciate anyone who was able to stay awake and stick with me. Obviously, these are interesting and different times. So the easiest way, frankly, to reach me is email or my cell phone. So my email is Sean, SEAN, @AmericanIRA.com. And feel free to call me on my cell. That number is 828-231-3627. All right, Bob, you still awake?
Yeah, I'm here, Sean. Can you hear me?
Yep.
Okay. Hey, thank you very much. Does anyone have any questions for Sean? I think the real value of American IRA is the kind of expertise and personal hand holding through your deals that the folks that are like Sean can give you. Does anyone have any questions for Sean?
They're all asleep, Bob.
Yeah, okay. Okay, well, if anyone has any questions for Sean after this, you know how to reach him. And again, I really appreciate this, Sean. I appreciate the free setup you give us. So wait, okay, well, we have a few people saying great meeting, Anthony and Lori. Yeah, by all means, well, thank you, Sean. If there's any questions you have for Sean, you know how to reach him. And likewise, if there's any way, Midlands REIA can help connect you with people like Sean, by all means, let us know. Okay. Well, thank you, Sean. I appreciate it.
Yeah, thank you all so much, Bob. Again, you've always been really generous, and we appreciate the time. And again, hopefully everyone's staying safe and healthy during these precarious times. And I love getting down to that meeting. I'll try to do that when everything is kind of back to normal. But again, I appreciate everyone being willing to listen to this tonight. So thank you all so much.
Next time you come into town, assuming this pandemic's lifted, let us take you to the normal speakers dinner. Okay.
Love it. Awesome. Appreciate it.
Okay. Thanks a lot, folks. Everyone have a great evening.
Thank you all.
Thanks, Sean.
Thanks, Bob.